Question number 26. State whether the following statements are true or false. Interest rate parity. In perfect market, when there are no restriction on flow of money and no transaction cost, the real value of monetary asset would be the same irrespective of the currency of the investment. And second, foreign exchange reserve. The total reserve that a country holds in foreign currency, including gold reserve, these are called foreign. So the answer will be C, both. Both the options are correct. Forex exchange reserve not only include your dollar or other capital inflows, it also include gold reserves. And interest rate parity, let us discuss about interest rate parity first. Say as of now, as on date, $1 is equal to rupees 85, and the rate of interest in America is 5%, whereas in India it's 10%. So as per the interest rate parity theory, $1 after a year will be 85 into 1.1, that is 1%, that is 10% growth because of the 10% rate of interest, divided by 1.05, that is US interest rate. So your value of your rupee after 1 year will be 89.04. So this is the conclusion. So when interest rates in India are higher, your value of your currency will depreciate. So it will make that particular parity in terms of exchange. But in the real world, this doesn't hold true. This may be true in longer run because we have never seen rupee appreciating on a longer streak. On a larger period of time, rupee depreciates only. But when America, say for example, if reduces or curtails its interest rate, so for that particular time period you will see there is more capital inflow in India because of the high returns, but that is of more of a shorter tenure. So the interest rate parity can be explained through this particular formula. So based on interest rate parity or this particular forward rate, that is a spot rate into rate of interest in country A and divided by rate of country in country B. So in the instant case, it's India and USA. So you know that value of rupee after 1 year will be 89.04. So this rate will be used in doing the hedging. So that is called covered interest rate parity. So you believe that after 1 year the value of rupee will be 88. So 88 will be the covered parity, whereas remaining 1.04 rupees, that is 89.04 minus 88, that will be uncovered interest rate parity. Question number 27. Which of the following is not component of technical analysis? So price patterns, moving averages, earning per share, or relative strength index. So this is technical analysis, this is technical, this is technical, this is fundamental. So the correct answer will be option number C. Let's discuss about a relative strength index. What is relative strength index? This was introduced by J. Wilder Jr. in 1978. RSI is a leading indicator that measures the intensity or strength in the price movement during a particular look-back period, which is generally of 14 days. For calculating the RSI, the value of RSI moves between 0 to 100. So this is the graph, which these are two parallel lines. So here it is 100, here it is 30, or sorry 0. So it says when a particular share is overbought, it will touch 100 mark, and when there is a downtrend and it touches 70 point, that's the time you should sell it. Likewise, when it reaches 0 or near 0 means it's oversold, and it's crossing 30 means again it is going to be bought by people, that this is the time where you should buy it. So these between two lines, then it may be moderate, it may not be overbought or oversold, but in these particular areas, based on the quantity of shares, you may decide whether you should buy a particular share or not. Hope the concept is clear. State which of the following statements are true. Time value of money, regarding a statement that a sum of money today is worth less than the sum of money future. So this is wrong. A sum of money today is worth more actually, because you are going to get a return, say 8% interest rate you are going to get. So after 1 year it will be 108, not 100. And second statement is working capital management is considered a short-term financial management decision. Absolutely right. So the answer will be option number B only. Bid-ask spread in an exchange rate quotation refers to the interest rate differential between two countries, the difference between the spot and forward rate, the difference between the buying and selling price of the currency, and the variance in exchange rate due to inflation. So the answer in the question will be option number C. Bid ask spread. Bid means buy, ask means sell. So the question itself is very much clear. So let us see what is actually bid ask spread. So a market maker, say a bank, market maker are entities which give two-way quotations. Means they will buy it and they will sell it, but they will give you the quotation of buying and selling separately. So in this two-way quotation, this will be the buying rate and this will be selling rate. So you know the difference between two will be the profit for the market maker. So here the difference will be 2 pips. So this is the profit for the market maker because they will buy it euro per Great Britain pound. So they will buy euro at this rate and sell it at this rate. So this will make the difference. And on the other hand, forward and spot rate, in the first example, you know, the spot rate was 85 and forward rate was 89 point something. So the basis will be 4 point something. So those will be the basis points. Last question of this series. In the balance of payment, when a country earns foreign exchange through export, the amount is considered or entered in the dash, or on the other hand, if the financial flow does not represent earning, it is entered in. So balance of payment is just like an accounting entry. When it is related to your day-to-day transaction or this export, this is an accounting transaction, so it will go in current account. Where it is other than this, say FDI or FII, then it will go in capital account. So answer will be option number C. So let us understand what is balance of payment. So in balance of payment, account are bifurcated into two parts. The first one is current account, that is more related to the transactions, and capital account, they are related to the, say, balance sheet of a nation. So they are related to the balance sheet transaction, they are related to the P&L or the account or business transaction. So again, current account is bifurcated in two ways, visible and invisible. Visible are goods, invisible are services, income and transfer. So when there is a deficit in the visible, this is called trade deficit, and where is deficit in the current account itself means imports are more than export. Import of not only goods but services, income and transfer, this will be in current account deficit. Or on the other hand, your capital account, like you availed loan, so you had fund, so that is your FDI or say government borrowing or ECB, your foreign direct investment, foreign institutional investment, NRI deposit. So this way, in balance of payment, your current account is always going to be equal to capital account, because at the end of the day it's a balance sheet. So your capital will be equal to your current account deficit and your foreign asset. Suppose you create an income and expense, when there is a deficit, you will treat it as an asset. You will take it to the asset side. Whereas forex assets, they are in asset side and capital is in the liability side. So it's like liability is equal to asset. So this way your balance of payment is always zero. If you have current account deficit, means you will have a capital account surplus. Hope this is clear. I'll come up with the next series in short while. Till then, thanks.